In the current economic landscape, economists across the globe are dialing back on growth forecasts for 2023. Inflation continues to soar higher, with surging interest rates, and the possibility of a recession in the coming year is still very real. While a bull market is inevitable, many market strategists think it's highly unlikely to go from one market to the other without going through a recession. However, the recent market weakness will most probably prove to be a long-term buying opportunity for stocks. But it is important to be critical of stock selection in a bear market. According to Wall Street strategists, it is a time to resist the bargain basement appeal of beaten-up stocks, and focus on high-quality shares. Looking for long-term growth stocks in such market conditions is one of the best strategies to capitalize on the upcoming bull market. Therefore, here we have compiled a list of the top 5 growth stocks to own for 2023 and beyond. Up first on our list for today is the American biotech giant, Vertex Pharmaceuticals, which is a global leader in cystic fibrosis treatments. Trading under the ticker symbol, VRTX, its 4 commercialized CF drugs bring in billions of dollars in revenue and profits on an annual basis. Even better, the biotech expects its leadership to continue at least until the late 2030s, as it diversifies and expands its portfolio. Its trikafta has still much room for revenue growth, as it wins reimbursements in other countries and approvals in other age groups. There's even a new CF candidate in the works for CF patients that can't be helped by its current treatments. Additionally, the giant is also diversifying its product pipeline with numerous new drug candidates in other therapy markets. Its pipeline has 18 programs with a credible chance of being commercialized over the next decade. From a very conservative perspective, the company could very well bring 5 new medicines for sale by 2032. This means at least several $billion in new revenue in addition to its CF drugs. On the financial front, the biotech is advancing well with an 18% increase in its product revenue of $2.33 billion in the third quarter of 2022. The adjusted earnings increased by 14% year-over-year to $1.04 billion, with earnings per share of $4.01. The company ended the quarter with cash and cash equivalents of $9.8 billion. Resultantly, the company sees its full-year product revenue between $8.8 billion to $8.9 billion. All in all, Vertex is a growth stock worth adding to your portfolio for the long term. Up next is the leading semiconductor manufacturer, Advanced Micro Devices, which trades under the ticker symbol, AMD. Based in the US, the company designs microprocessors for computers and consumer electronics products. A major part of its revenue comes from the sales of CPUs and GPUs in the personal computers and data center markets. Even so that recently, the company earned a 2022 SEAL Sustainable Product Award for innovative and impactful products for a sustainable future in data centers. AMD also supplies chips for gaming consoles like Sony PlayStations. In 2022, the company acquired Xilinx, an American programmable logic devices company, to diversify its business and increase end market opportunities. Moreover, this month the company expanded its partnership with Vietel High-Tech for deploying a 5G network field. The 5G network field will serve over 130 million Vietel mobile customers worldwide. Despite the softening PC market and ongoing economic downturn, the company did alright in the latest quarterly results. In the third quarter of 2022, the chip maker came out with a revenue of $5.6 billion, which rose 29% year-over-year. The adjusted net income was nearly $1.1 billion, which marked an increase of 23%. The balance sheet remained strong with cash and cash equivalents of $5.6 billion at the end of the quarter. Management is expecting a revenue increase of 43% for the entire year. Thus, given the semiconductor market's bullish outlook, and AMD's continued progress and expansion, the stock is on track for continued growth in the years to come. Analysts expect around a 28% increase in annual earnings over the next 3 to 5 years, as per S&P Global Market Intelligence. Hence, AMD is a great growth stock to own for the long term. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Next in line is the world's largest electric utility, NextEra Energy, known by the ticker symbol, NEE. It is a public utility holding company that generates, transmits, distributes, and sells electricity. The company owns some of the best wind and solar energy generation sites, which gives it an advantage impossible to replicate by others. With its renewable energy assets, the company is the largest renewable energy producer in North America. In the third quarter of 2022 alone, the company signed around 2,345 megawatts of new renewables and storage projects. The company continues to deliver strong financial growth with earnings of $1,683 million, or 85 cents per share in the latest quarter. The comparable figures were $1,483 million, and 75 cents per share respectively. For the full year, NextEra expects adjusted earnings per share to be between $2.80 and $2.90. The forecast for the following years is EPS of $3.13 at the higher end for 2023, $3.43 for 2024, and $3.70 for 2025. Furthermore, the utility has a return on equity of 12.27% against the industry average of 10.2%. It also has a well-chalked-out investment plan of $85 to $95 billion in various projects from 2022 to 2025. NextEra recently inked a deal worth $805 million for acquiring 49% interest in a 1.5 gigawatt renewables portfolio. Additionally, the company is a dividend aristocrat, raising its dividend for 28 consecutive years. This year, it raised its dividend by a nice 10%, and expects to continue doing so annually through at least 2024. Thus, its long-term investment plan, continued earning growth and dividend increase, makes NextEra a great growth stock worth owning for the long term. Up next is a payment technology leader, Visa Incorporated, which trades under the ticker symbol, V. Based in the US, the digital payment services company's services are used by millions of people every day. It helps facilitate credit card transactions and pockets fees for it. The company powers around 40% of the world's care transactions, the most done by any brand. What gives the company an edge is that it does not actually issue credit cards. Instead, it just processes transactions, helping it avoid credit risk. This helps Visa generate sustainable revenue growth even during economic downturns. The company has continued growing its annual revenue consistently, with an average annual revenue growth of 11% over the past decade. Its operating profit has increased by 12% on average. In the fiscal year ended September 30, 2022, the company generated $29.3 billion in revenue, which surged by 22% year over year. Despite the economic conditions, the cross-border volume saw an increase of 38% in the year. Furthermore, the adjusted earnings per share jumped by 27% year over year to $7.50. Net income was $15 billion in the quarter. According to analysts, Visa's earnings per share are expected to deliver an average annual growth of 15% over the next 3 to 5 years. On top of its continued revenue and earnings growth, the company still has ample opportunity to expand its payment structure into emerging markets for years to come. Additionally, it also pays a dividend and has been increasing it by an average of 21% annually over the past decade. Suffice to say, Visa is another great growth stock worth holding onto for the long term. The final stock on our list for today is a Canadian cloud-based commerce platform, Shopify Inc., which is represented by the ticker symbol, SHOP. The company's shares have suffered the most significant decline in their history, losing over 73% year to date. Despite a 10-for-1 stock split, the continued bear market and e-commerce slowdown have impacted the stock severely. However, the e-commerce sector is slowly reverting to pre-pandemic growth trends. According to the Grand View Research Project, the sector is expected to grow at a compound annual rate of 14.7% through 2027. In the latest quarterly earnings, the company reported an increase of 22% in its revenue, and the net loss per share was just 2 cents. Even though Shopify had some hiccups this year, it is well positioned to profit amid the expected e-commerce growth. It has become more than a point-of-sale company, and is now a vertically integrated services provider for small to medium-sized businesses. It has created an ecosystem to provide business owners with everything they need, from payment options to business loans, and a chance to potentially reach hundreds of millions of consumers on social platforms. Moreover, the company has already reached an impressive position in the market ranking, as the #1 e-commerce platform in the US according to BuiltWith. Globally, the company ranks second, coming only after WordPress e-commerce plugin WooCommerce. Nonetheless, Shopify comes with a key advantage over its rival and most of its peers, with its scope which is not limited to just software. Thus, the stock is poised for much growth in the upcoming years, making it worthy of owning in 2023 and beyond. That's all from us in today's video. We hope that the insight we aimed to provide has been of some value to you, and would help you identify the best growth stocks worth buying for the long term. We would love to know your feedback in the comments below. If you would like to know more about different stocks and various investment opportunities, check out our website, stockstelegraph.com.